So this is co-authored work with two colleagues, Vern and Roy, who are both at the University of Arkansas, and I'm from the University of Washington. So the pretty simple goal of our study was to try and figure out whether social media activity, right, discussions that people were having following an earnings announcement had information or whether they were essentially just noise. So the theory behind what we were interested in here is investor attention. If more investors are paying attention to the information that's announced, does the market price reflect that information more quickly? Right, so it's a fairly standard theory if you think about it, and one that hopefully we can believe in as long as we don't believe that markets are perfectly efficient. So why did we choose to look at earnings announcements? These are our priors about earnings announcements. Earnings announcements have what are called post-earnings announcement drift. So after the earnings announcement, we see that in the same direction as the news in the earnings announcement, we see future returns in the same direction, right? So we've seen PEED. It's fairly robust. It's been around for a long time. This figure's from 1984. We know that some of the signal has kind of atrophied over time, but this is an anomaly from a market efficiency point of view. So what is our kind of predictions here with the role of social media? So what we're going to do is we're going to split up our earnings announcements into 5 groups, good news groups and bad news groups. So this is going to be relative to the analyst forecast. So a very standard approach to measuring the earnings surprise. And what we're going to do is we're also going to sort the reaction into 5 buckets based on social media attention. So at the bottom end, we're going to have our low social media attention, the high end, our high social media attention. We're going to sort our firms into these buckets, and our predictions are that social media enhances price discovery, right? Or it's at least a factor that is associated with price discovery. We are going to keep the priors from the earnings signal, although some of these earnings signal priors may have gone away. But the prior here is that good news is related to more returns than bad news in the, say, 60 days after the announcement. So relatively simple setup, and this is the evidence. This is what we find. We find, at least for some section, that there is a much lower drift associated with higher amounts of social media. Right, so on the surface, this is consistent with the idea that higher attention to earnings means that there is less drift. There is less mispricing following the earnings announcement. You'll notice that because we only have a few years of data, and I'll get into some of these discussions soon, we don't always have very strong statistical evidence. But the magnitudes and the directions are interesting. In contrast, down here we only found that the lower to middle social media groups had earnings responses similar to what we've seen in the past. We have instead over here for our high social media groups some kind of anomalous evidence. Right? We don't expect that over a period of time after the earnings announcement that good news will underperform bad news. Right? Now at the highest end of the social media, we're not exactly sure what's going on there because it's not what we think of as statistically significant. But the Q4 finding there is a little bit anomalous. And the only kind of conjecture that we have about this at the moment is that these stocks have some kind of over-anticipation or over-excitement kind of effect that's being displayed through the social media. And it might be what you would consider as a reversal, right? A post-earnings announcement reversal. That's what I think people have been calling this evidence. I want to point out that this is not super strong evidence. This is only based on a couple of years of data. So why is this interesting? Why did we do this as academics? So we wanted to test a theory, right? And our theories tend to relate to market efficiency. We want to look at evidence that is either supporting or not supporting market efficiency quite often. So if we think about social media, why might it help enhance information sharing, right? Information dissemination. It rapidly communicates that information very quickly through a network, right? It provides additional interpretation and context, potentially, which could be useful. And I like to think of it in some senses as kind of a measure of excitement based on what I've been reading of these kind of stock tweets that I've looked at. On the other side, we have our downside. So there's a potential of overreaction. People are maybe noise traders here, overreacting to a signal, not really thinking about what they're doing, but being carried away by some excitement. Miscommunication could be a potential problem here, as these are individuals providing the information. I find this stuff fascinating to read from an academic perspective, because not only do we have the sharing of information and passing on of information and links and so on, but we see a lot of opinions and predictions that are being talked about in these tweets. A lot of I told you so's, especially at the end of the day of trading. These are people who are telling us that they have just come up with a massive return on their options, and additional kind of babble and chatter. That's all in this kind of set of information. So if you think about it, it is unstructured, it's got some noise in there, so is there some relevant signal? From a theoretical point, why this is interesting for us is that the primary reason that we believe post-earnings announcement drift exists is due to underreaction to the earnings signal. So typically when we see an earnings signal, an earnings surprise, we think of that as a persistent shock to the future cash flows. And if earnings announcement drift is to exist, one potential reason for that is that people are underreacting to that signal. An interesting potential use for social media is a measure of reaction. So I'll talk a little bit about the data. It's a very standard academic setting in terms of the first set of data. We have our price data and our return data from CRISP, right, which is the typical source that we use. The measure of social media activity, the data that we use in this study, is provided to us by Market IQ. And the particular measure that we're interested in is the measure of social media activity, and they call it smart velocity. And this velocity measure is cleaning up some of the information in the tweets, and it is picking who they believe are influential. It's an algorithm. I cannot provide you with all the details of it, but the idea is, in my mind, it picks up increases in excitement. We also looked at the timing of the earnings announcement and the content of the earnings announcement using a variety of sources such as IBIS for our forecast errors and our RavenPack data as well. I'm also going to show a little bit of information from the traditional news, and that's from RavenPack as well. We kind of put them up on the same figure. We also looked at Google search, and the only reason we really looked at this is because there is some literature out there that suggests that people anticipate news events and they go out and search on Google. We're kind of thinking more of the reaction to the earnings announcement as opposed to the anticipation of the information in the earnings announcement. So we're slightly different. Wanted to put up a couple of examples. This is the type of information that I've been reading through just to kind of wrap my head around what is on the stock twits. This is actually from stock twits, which is fascinating stuff. This is on a day of an earnings announcement. What you notice is a lot of them are talking about earnings, right? They're providing opinion about the earnings. And so it's actually quite interesting information because the earnings just came out and the people are talking about the earnings. We've looked at all sorts of other potential signals. There isn't as much excitement about any of the other accounting announcements than there is that we see for earnings. But you can imagine things like comment letters could potentially lead to people talking about fraud or earnings quality. We haven't discovered that yet, but we have seen that they pay a lot of attention to earnings in some cases. This is how the data arrives to us. We get some velocity measures. These velocity measures are spikes. So it's baselined at 1. So for example, the one over here, the 17.43, that would be a high spike in attention following the earnings announcement. Whereas on the second example over there, the 2.26 for velocity, that would be a low level of additional interest following an earnings announcement. So the main finding, as I kind of highlighted at the beginning of my talk, is that social media activity is going to potentially help us predicting these PEAD returns, these post-earnings announcement returns, or help us sort out what is going on after an earnings announcement. So one of the things I wanted to highlight just quickly on the side there, it was mainly the positive earnings announcements that we find results for, and it's not so much the negative earnings announcements that we find that this is interesting for, useful for. And we find that the PEAD effects, there's no evidence of PEAD for the low attention stocks, and about 1.6% spread over that 60-day period. And that's pretty much the entire mean of the post-earnings announcement drift, it seems like. So next thing I wanted to do is just see if this is abnormal and what it looks like in terms of activity on the social media websites. And so this is using the measure of velocity. And then the second thing I wanted to show is, does it create a tighter link? So does more attention mean that the markets are responding to the earnings signal more strongly? And so here's the first one. And you'll notice that relative to the days around the earnings announcement, when the earnings announcement occurs, social media activity jumps up. It spikes very dramatically. Right? There is really very little need to run a statistical test on this when you look at that data, but we have run statistical tests, and it is significant both for good news and bad news. This is our kind of nonlinear response to earnings. So earnings surprises that only beat the analyst forecast by a small amount or miss by a small amount have the much sharper returns, right? And so we see that. What I wanted to do to kind of give you a benchmark here, we think about high growth stocks as having very sharp or nonlinear responses to earnings announcements. To put it in perspective, our growth stocks here are much duller than the high attention stocks. So the high attention stocks are the ones that do have the sharpest responses to the earnings announcements. So the next thing I wanted to talk about was the obvious kind of partitioning of returns across the period of time, given that most earnings announcements come out after hours. So a lot of what we pick up here is information that's released after hours. This is just the frequency of earnings announcements at various half-hour intervals during the day. So now what we wanted to do with this was start to overlay the social media responsiveness, because you can imagine that if earnings is happening after hours at the end of the day, there could be a whole bunch of people who are talking about earnings throughout the day, and so we might see a gradual increase. Or we could just see big reaction effects. And remember, those two ideas of attention are very different, anticipation versus reaction. We, of course, are interested in reaction. So here's the volume of social media that we see surrounding the earnings announcements. You'll notice that for the before, in the yellow here, when a company announces earnings before the market opens, we do see a sharp increase in discussions about earnings, right? And this, again, is most likely a reaction. People are not getting up at 4 o'clock in the morning and starting to talk about the upcoming earnings announcement. They see the information and they start talking about it. The same thing at the end of the day, we see some marginal increases towards the end of the day that is potentially some kind of an anticipation. There's discussion about the upcoming earnings announcement. But really, when the earnings announcement comes out, the discussion begins. And so this is why we think of it as a good measure of attention from the point of view of reaction. This is centering it on the earnings announcement just to make it a little bit more clearer. So now we've, instead of putting it over the course of the day, 0 represents the time of the earnings announcement. And it just really highlights how what we're finding here is a reaction or a response or a discussion about the earnings news that has come out. And again, when we think about this as also sharpening the response to the earnings surprise, it seems that what we're seeing here is discussions about earnings. Discussions about earnings announcements and, which hopefully if I can convince you on the next couple of slides, we believe is enhancing the efficient response to that earnings information. So here's where the news events happen. You'll notice that news events decay a lot faster than the discussions in social media. There was some discussion about dispersion of opinions earlier. That could potentially be part of this discussion here, and that could be quite interesting to look at as well. We haven't done that, but you see that these signals again do die out within about 8 hours after the earnings announcement. So now we're going to just kind of look at what we can get from a normal trading day. We're going to ignore all of the pre and post market, and we're just going to look at these returns from the close on the day of the earnings announcement. Remember, the close doesn't contain the after hours earnings announcement news yet. It can contain some anticipation of that information, but it doesn't contain the information just yet. So the close to open returns, what do we see? We see that it actually comes through on the negative side. Right? So the negative side, when bad news hits the market, we see some big differences, not big differences, sorry, statistically significant differences between low social media activity and high social media activity. We also notice that everything looks like an earnings response. Good news announcements outperform bad news announcements in every single case. And we also see that the bad news announcements tend to have negative returns, the good news announcements tend to have positive returns. Exactly what we had anticipated, which is great. This would suggest that the markets are responding to that information. Let's take a look at the, we can't get that overnight return potentially. I know a lot of people don't like trading outside of the normal trading hours. So what would happen if we started trading at the opening price on the first day after the earnings announcement? So remember, our high attention stocks overnight had a lot of negative returns for those who missed their earnings announcement. The bad news events have already impounded a lot of that information. What we see here is that the positive news on day one is starting to be reflected in market prices. So on day one, as soon as the announcement has occurred, we start to see that our high activity, high social media, or high attention stocks start to outperform the low attention stocks. And this is concentrated in the good news. We also see, again, that all of our good news minus bad news events make sense. So what do we think is going on? So down on the other end here, you'll notice that the low attention stocks, they don't really have much of a return. And by not having much of a return here, perhaps that information hasn't been incorporated into the price yet, and that's why we see the drift results that we do. So I've found this a fascinating thing to look at from an academic perspective. We believe that there is a theory that when investors pay attention to markets and they're actively trading on information, then it will improve price efficiency. And social media has given us a really nice kind of measure to get at that. So we can see a faster incorporation of the earnings announcement news. It seems that price discovery is sped up when there's higher amounts of social media activity. On the other hand, when there isn't much social media activity, when we have what we might think as inattention, we see drift. Right? We see post-earnings announcement drifts following the news event of earnings. For a purist, I can't use the word causal, but what I'm going to say is it's suggestive of a causal link between attention, right, and market efficiency. And so where we see the inefficient prices are going to be the low attention stocks. It's quite distinct in the data, and thank you for your time. That's great.
So we're going to open up for a few questions.
I have not been following this in the academic world, but I have a simple question.
Yep.
is the participation in the social media contributing to volatility?
In terms of the portfolio volatility, that would be
In terms
reflected.
of, let's say, the volatility of the prices of the assets that are discussed in the media.
Right, so that's kind of what I was getting at when I talked a little bit about how we didn't look at dispersion of opinion between the tweets, but that would be fascinating to look at. We haven't done that yet, but we certainly can take a look at it, and it would be quite interesting.
Interesting too.
Thanks.
Could be the market cap is a factor there because you have the stocks followed by most of the investors tends to have a lot more tweets versus the ones that don't follow much by average retail investors.
Yep. So the way that we kind of try and get around that is we take out the size decile return, so we take out a size effect. We can't control for size perfectly. Obviously, some stocks that have never had any attention are probably going to be smaller stocks. So I agree with you on that point. But there is definitely some variation within firm. So across the different quarters, we can see differences in social media activity. And so it's not always that the same big firms are in the same big social media attention buckets.
Yeah, according to one of the graphs that you showed, it seems that the attention is the minute of that the announcement is out, which is after hours, and then a little bit the next day, and then it dies. So what I didn't see is any graph about the post-earning announcement drift. Does it die after the attention dies? That's what I didn't see, and that's my question.
Right. Yeah, we could definitely come up with some figures that would match up the attention here with that original figure that I showed from the Foster Olson Shevlin paper, the kind of prior that we have about PEED. And I think that would be a really interesting graphic. We just haven't visualized the data that way yet. But yeah, thanks.
Okay. Excellent. Asher, thank you so much.